Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Commentary, June 2 Updates. This video presents a direct informational narration of the source document. All right, let's dive right into the explainer for June 2nd. So the NASDAQ Composite managed to close just slightly higher today. But here's the really interesting part. After a massive, continuous rally, we actually saw software equities take a pretty significant pullback today, with capital rapidly rotating right back into the semiconductor sector. You know, Wall Street capital inflows are just incredibly dispersed right now, bouncing rapidly between different assets. If you don't adopt to this rhythm, honestly, you could miss the trend entirely. The biggest risk we're seeing in this kind of environment is poor directional positioning, basically suffering through sell-offs in the stocks you're holding while totally missing out on the ones that are surging. Oh, and touching on macro events really quickly, Donald Trump informed the media that negotiations with Iran are actually progressing smoothly, and they plan to reach an agreement next week. The crude oil market, though, it seems pretty skeptical, or at least largely defensive about that statement, as oil prices just continue to rebound. Meanwhile, the S&P 500 index continues to hover right around that 7,600-point level. Now, if we look at the indices lately, intraday volatility has really been contracting, right? We're seeing consecutive small bullish candles and doji formations. The NASDAQ, for its part, continues to show this incredibly strong, relentless bullish trend. But, and this is a big but, Citigroup's strategy team just issued a rather stark warning. They pointed out that the NASDAQ 100 has been sitting in technical overbought territory for almost the entirety of the last 6 weeks. Long positioning has gotten excessively crowded, and what does that mean for us? Well, it significantly elevates the downside risk associated with profit-taking and the unwinding of those long positions. The Citi team also added an interesting comparison. Unlike the NASDAQ 100, the S&P 500 still holds a considerable volume of short positions. That actually provides some serious potential for a short squeeze, giving the S&P some degree of short-term structural support. To put this into perspective, let's look at history. The NASDAQ 100's weekly RSI staying in the overbought zone for 6 straight weeks, it's actually not unprecedented. For example, back between May and July of 2023, the NASDAQ 100 stayed in overbought territory for 11 consecutive weeks. It literally wasn't until the 12th week that a 10% correction finally materialized. So the core issue here isn't just the duration of this 6-week overbought streak. It's the sheer velocity and the steepness of the current rally. Get this, the gains we've accumulated over just these past 6 weeks are equivalent to the gains of the previous 112 weeks combined. That is just wild. Now, in stark contrast to that equity rally, Bitcoin has been putting on a pretty dismal performance. Its intraday price dropped down to $66,000, representing a significant decline from its historical high back in October of last year. In the fallout, over the past few hours alone, we saw more than $1 billion in forced cryptocurrency liquidations. $1 billion. The crypto market has basically fallen right back into the fear zone as this massive ongoing AI investment boom just continuously siphons capital away from cryptocurrencies and directly into the equities market. Speaking of that AI boom, over in the technology sector, NVIDIA's CEO Jensen Huang is continuing his promotional tour in Taipei. After highlighting the communications sector, he shifted his focus over to Marvell technology. Following a recent pullback, the communications sector rebounded hard today, with the CCH index surging 17.6%, vastly outperforming the S&P 500. Huang stated something absolutely crucial. The ultimate constraint on AI isn't actually compute power, which many assumed would just be electricity, but rather connectivity. Because of that statement, optical communications equities immediately surged. Now, Huang clarified that both copper and optical interconnects are going to play critical roles for years to come. The strategy is to utilize copper wherever it's feasible. And once copper just can't meet the operational demands anymore, scale up using optical interconnects. Right after he said this, Marvell technology gapped up significantly. Huang actually positioned Marvell as the next prospective trillion-dollar entity. So let's unpack that for a moment. With Marvell's current market capitalization sitting at $254.3 billion, reaching a trillion-dollar valuation implies a 4- to 5-fold increase in their share price. This endorsement isn't without underlying financial ties, though. Back in March of this year, NVIDIA invested $2 billion into Marvell technology, solidifying its status as a strategic partner. It's clear Huang's market influence is highly effective in driving equity valuations. Marvell is currently heavily focused on AI data center networking, custom AI silicon, and optical technologies. This diversified approach of producing custom chips alongside optical components defines its strategy, even though custom silicon remains its core business. This momentum also drove up shares of another custom chip leader, Broadcom, ahead of its post-market earnings report tomorrow. While Broadcom's fundamental performance is expected to remain robust, the subsequent price action remains unpredictable. Moving to the server hardware space, Hewlett-Packard Enterprise, or HPE, saw its shares completely surge post-earnings. After opening high, the stock experienced some wild intraday volatility, peaking at a 37% gain before narrowing down to a 19.5% close. HPE's earnings were notably strong, really confirming that the AI boom is igniting massive demand for both server and networking equipment. They reported Q2 revenue of $10.7 billion, which is a 40% year-over-year increase. Adjusted earnings per share reached $0.79, far exceeding the projected $0.53. Additionally, the company significantly raised its full-year revenue growth guidance. Because of that surge, HPE's valuation is now considerably higher than that of Dell Technologies. This prompted short-term capital to quickly lock in profits and rotate into buying Dell on the dip. This perfectly aligns with Dell's recent better-than-expected earnings, mutually validating the sustained, robust demand for both AI and traditional servers. Supermicro also benefited from the positive sentiment in the server sector, announcing a partnership with ARM for energy-efficient AI servers. However, management execution concerns keep the primary institutional focus mainly squared on Dell. Now, here is a largely overlooked development we need to focus on: the severe fundamental pressure facing traditional exchange operators. The Chicago Board Options Exchange, or CBOE, saw its stock plummet 17% over 2 consecutive days, marking a nearly 27% drawdown from its peak. CBOE's most profitable segment is the transaction fees generated by VIX derivatives, which, as you know, thrive on market volatility. The current environment of extreme market stagnation and declining volatility has reduced the demand for VIX hedging, consequently compressing their fee revenues. Compounding this, CBOE announced today that it received formal SEC approval to launch a 24/5 trading mechanism by the end of the year. Operating an exchange around the clock is going to result in an exponential explosion in operational costs. Furthermore, extended trading hours do not guarantee a proportional increase in aggregate volume. Instead, they may just dilute the existing liquidity across wider timeframes. Consequently, institutional capital is preemptively exiting these positions. As technology stocks continue to absorb market liquidity, traditional derivative exchanges like CBOE are being utilized as primary liquidity sources by institutions. Another major player, the Chicago Mercantile Exchange, or CME, has also experienced sustained institutional capital outflows, resulting in a vertical drop in its stock price to a more than one-year low. These traditional exchange giants are facing a direct, asymmetrical competitive threat from decentralized exchanges, specifically hyperliquid. Traditional futures contracts are burdened with expiration dates, mandatory rollover requirements, exceptionally high friction costs, and cumbersome onboarding processes. In stark contrast, hyperliquid's perpetual contracts require no rollovers, no physical delivery, offer up to 40x leverage, and utilize an L1 blockchain for real-time on-chain clearing. Because of this shift, quantitative institutions that previously relied on traditional exchanges for cross-asset arbitrage and macro hedging are actively migrating their capital. The era of effortless profitability for traditional exchanges has decisively ended. The Intercontinental Exchange, ICE, is enduring similar industry-wide valuation compression, with its stock approaching a 2-year low. ICE's premier products, Brent crude, diesel, and natural gas derivatives, are rapidly losing market share to platforms like Hyperliquid. In fact, according to CoinDesk data, since launching in 2023, WTI and Brent crude oil contracts have accounted for nearly half of Hyperliquid's total trading volume. Silver and NASDAQ 100 futures are also experiencing massive trading volumes on these decentralized platforms. Thus, all 3 traditional exchanges are currently trapped in a severe phase of valuation contraction. For those considering a tactical entry among these 3, though, CBOE presents the most viable option. Options trading remains a monopolistic business model that perpetual contracts cannot easily replicate in the short term. Institutional options purchasing differs fundamentally from perpetual contract trading and is highly unlikely to be displaced in the coming years. Furthermore, the U.S. equity market will not remain in a state of suppressed volatility indefinitely. A midterm correction or bearish phase will inevitably cause the VIX to spike, driving capital back into put options and VIX upside bets, thereby restoring CBOE's fee revenues. The recent price collapse has purged the majority of its valuation premium, but stabilization must be confirmed first. Prudent strategy dictates observing for stabilization on high volume at the annual moving average, waiting for a technical bounce, or scaling in incrementally when market pullbacks trigger a VIX rebound. Strict position sizing is mandatory here, as valuation compressions can be ruthless regardless of underlying fundamentals. All right, let's pivot to the energy sector. Energy storage company FLNC surged 43.8% yesterday and added another 2.8% today. This was catalyzed by an announcement that German industrial conglomerate Siemens is partnering with NVIDIA to establish a trilateral strategic cooperation with FLNC, aiming to design comprehensive power and control system architectures tailored for hyperscale AI data centers. As a joint venture between Siemens and U.S. power giant AES, FLNC is definitely not lacking in foundational backing. Leveraging its parent company's deep global power infrastructure network, FLNC has rapidly established a leading global position. According to a recent report by S&P Global Commodity Insights published last December, FLNC ranks in the top 3 globally for installed and contracted energy storage capacity and holds the second largest market share in the U.S. domestic market, trailing only Tesla. Despite the price surging on headline catalysts, an analysis of its fundamentals reveals a highly speculative asset with severe operational disconnects. Following its Q1 earnings release in February, the stock plummeted. At that time, market demand showed explosive growth, with Q1 revenue surging 154% year-over-year and order backlog reaching $500 million. However, gross margins completely collapsed from 12.5% down to 5.6%, and net losses continued to widen. This was attributed to U.S. domestic supply chain bottlenecks. To capture U.S. government manufacturing subsidies, the company hastily constructed an Arizona facility. Severe delays in production ramp-up caused manufacturing costs to spike, severely eroding their profit margins. The recently released Q2 report was demonstrably worse than Q1. Quarterly losses widened by 33% year-over-year, and revenue came in at only $465 million, a growth rate decelerating to just 7%, completely missing Wall Street estimates of $623 million. Paradoxically, the stock did not decline. Instead, it initiated a massive new rally simply because management announced 2 new data center orders, allowing the stock to aggressively ride the NVIDIA narrative momentum. The institutional logic here is straightforward. Fundamentals act merely as a pretext, while price positioning and market narrative dictate capital flows. The post-Q1 dump occurred because the stock had previously rallied 400%, allowing institutions to distribute on bad news. The post-Q2 pump occurred because the stock had already bottomed out, allowing accumulated institutional positioning to use minor news to ignite a rally. For heavily narrative-driven equities like FLNC, long-term holding strategies carry extreme risk. The optimal approach is swing trading, scaling in at cyclical lows following earnings-driven drawdowns and distributing into strength when AI catalysts drive parabolic rallies. The company's poor execution track record guarantees future extreme volatility. In sharp contrast, Wall Street displays a clear preference for Bloom Energy, or BE, within the same sector. Bloom Energy's management has explicitly stated that their core business is highly profitable, and they have absolutely no plans for equity dilution or near-term secondary offerings. The capital expenditure payback period for constructing a new facility through product sales is a mere 6 months. Furthermore, management has repeatedly confirmed publicly that they face zero capacity bottlenecks. The sole pacing factor is the speed at which downstream clients can construct and deploy data centers. In an environment where AI data centers exhibit an insatiable demand for power infrastructure, it is evident why capital continues to favor Bloom Energy's fundamental trajectory. Lastly, as the World Cup approaches, DraftKings remains stagnant, oscillating deadlocked right between its 50-day and 200-day moving averages. Over the past year, prediction markets have severely impacted traditional sports betting operators like DKNG, driving its stock price down from $50 to $25. Prediction markets provide futures-like contracts for sporting events, directly cannibalizing DKNG's market share. Volume analysis shows no institutional accumulation positioning ahead of the World Cup. Current activity is entirely retail-driven consolidation. If the stock fails to gain momentum prior to the tournament, retail capital is highly likely to migrate to platforms like Robinhood. Robinhood now actually offers predictive event contracts for World Cup matches. Unlike DraftKings' rigid structure, where capital is locked until a final binary outcome, Robinhood allows users to trade event contracts just like equities. Participants can execute high-frequency intraday trades, dynamically adjusting to live match developments, securing profits, or executing stop losses right in the middle of an event. This structural advantage perfectly explains DKNG's stagnant liquidity. New prediction markets, represented by platforms like Robinhood, are systematically absorbing the retail capital that historically belonged to traditional sports betting operators. So, what does this all mean? As predictive event contracts reshape retail liquidity, it leaves us asking, which traditional models will fail to adapt next? This concludes today's explainer of the source material